Well, hello, everyone, and welcome to the One Startup World 2023 Summer Conference. It is the premier global startup conference dedicated to helping innovative and disruptive startups succeed. It is the perfect platform for startup founders to pitch their ideas, gain valuable insights, and connect with other like-minded entrepreneurs, industry experts, potential investors, and partners, learning from the best in the business. It is now my great pleasure to introduce first Mr. Farouk Siddiqui, the CEO of Defynance, and also to introduce Omar Fisher, the CSO of Defynance. And Mr. Siddiqui, I hand the floor over to you.
Thank you, James, and thank you to One Startup World for giving us an opportunity to present here today. My name is Farouk Siddiqui. Like James mentioned, I'm the founder and CEO of Defynance. As Dr. Omar Fisher will take us to the presentation, we have developed a new asset class to tackle student debt in a very innovative and disruptive manner. And all of us on the team, as Dr. Fisher will point out, have a tremendous background in financial services, technology, and risk mitigation. With that, I'll turn it over to Dr. Omar Fisher.
Well, thank you, Farouk. Oh, it is so exciting to be part of this One Startup World and having an opportunity to share what it is we are doing as a startup ourselves, Defynance, based out of Atlanta, Georgia, with offices in Tampa and also here, as you can see behind me, in Seattle. And among the aspects of the business we'd like to focus in on today is building a new asset class for investors. We have an exceptional team that has more than 80 years of business experience with multiple startups, as you can see, including Thomas Tellner, who is a data scientist that's helped us with our automated credit underwriting and the other aspects of the marketplace that we are building. So what is the problem which we are focused on? And keeping in mind that every problem also can create opportunities, right? Well, the problem is called the student loan crisis, which is nearly $2 trillion now, affecting roughly about 45 million Americans. And it was how they elected, or they, out of necessity, needed to finance their higher education, is taking out loans. These are either federal loans or private loans. Regrettably, the way the system has evolved in the last 40 years is to form a somewhat predatory environment where those who have taken out these loans and then graduated find themselves with very heavy debt burdens, which are having them postpone certain life events, as well as creating certain mental issues and maybe even health problems from the stress of servicing those student loans. So what's our solution? Well, our solution is a marketplace that has 3 dimensions. We refinance those private loans of the graduates, replacing it with an income sharing agreement structure we'll talk about in a minute. We have also a credit fund, which is what we'll speak into with this presentation, whereby Defynance raises the capital from investors who are interested to be part of the solution and help with not only the positive social impact, but also a very attractive rate of return. But in addition, we have a third leg to our marketplace, which is made up of partnership arrangements, including the one we have with One Business World, to provide career support, guidance, wellness, and financial education. And those graduates that are interested to move on into entrepreneurship can also tap into these resources. So essentially, the core of the business is we refinance student loans with always affordable income-based repayments. The process is very simple. In fact, Today, even as a startup, we have a backlog of about $15 million, which represents over 200 individuals who are graduates struggling with their student loan debts that are eager to participate in an income-based repayment scheme, which has built-in consumer protections. We don't have time to go into all of those details. However, maybe in the Q&A, or feel free to contact us. The main point of this part of the presentation is to explain that when we pay off those debts, the solution that we enter into with our graduates, our customers, is debt-free and interest-free. So now today, there are ideal conditions for investors to participate in the ISA credit fund that we spoke about. Why is that? Well, because it is an alternative asset-backed form of a security that has many characteristics similar to passive income securities, and yet it is debt-free and interest-free, which means there's predictable yield. Our proposition, not having debt, not having any correlation to interest or to the equities market or the debt markets, the bonds, we feel makes us much more competitive, both in the offering to our customers, the graduated students that are seeking to be debt-free, and also to these investors that are looking to diversify into alternative asset class type securities. So lastly, our overall pool is highly diversified, which we believe is quite attractive to investors. It's diversified by geography across the US, it's diversified by occupations, and it's diversified by age and credit profiles of the customers that go into the pool. So what is the size of the market that we're addressing? Well, there are, on the private side, there's about 600 billion of the nearly 2 trillion in student debt that I mentioned. So that's our addressable market. And then Defynance comes into the graduates who are gainfully employed in certain target occupations like nursing, healthcare, architects, lawyers, certain professions, we feel, and that addressable universe is about 600 billion. Now, if we were to quickly compare the characteristics of the ISA credit fund with your conventional fixed income, and I'm not going to go through the entire slide, but it's available for you to request through One Business World or directly from us. But the key points here are typical fixed income, of course, is related to interest rates. So as interest rates go up, if you've already bought a bond or a debt-based ABS, then actually the principal value goes down because current investors can have a higher yield than what is offered to what you had bought previously. That's not the case with the ISA fund. Why? Because we are geared, we said, to income sharing. Now, income and wages across the US marketplace have been relatively steady in the growth pattern over the last, I would say, at least two generations, so 60 years. And the last thing I will say is that we have in this fund a variable rate of return, but it's capped for our customers so they know the maximum that they would need to repay to the Defynance credit fund pool in the event that their earnings happen to go in a trajectory much higher than was predicted at the time of the credit underwriting. Both the conventional debt securities and ours are exposed, of course, to non-payment and certain default risks. However, built into the ISA credit fund are certain offsetting principles that we believe make it extremely attractive as an investment. So let's talk about the rate of return. You can see on the right side of the slide, the comparison to T-bills, to IG bonds, and also to the S&P 500, which is the yellow line. The green line shows you our credit fund performance to date. You can see that it's steady. And also you can see that although we might be underperforming the S&P 500, we are overperforming on other occasions when it is dipped because of market conditions. And after nearly 2.5 years, you can see that the ultimate rate of return is pretty similar. And in terms of the risk profile that our credit fund offers to investors, it has predictable cash flow. There is an element of liquidity to this, as well as we've said, the yields overall are non-correlated to interest rates, non-correlated to the stock market and the bond market. And so that chart shows you a very favorable positioning in terms of the return versus the risk. The risk is very low volatility in the structure of the ISA agreement with our customers. So now, in every crisis, and we've talked a bit and characterized the student loan crisis, there are opportunities. And so we, as Defynance, as a startup, have chosen to focus in on, frankly, it's a difficult job because it's new, like a lot of other new technologies to be introduced, and will require some education. And again, that's really what we try to focus on, and are happy to be part of the One Startup World talks this week, is to expand out the audience that we can help educate and help them become more comfortable with this new alternative asset class. And we feel that this is far superior to the typical and conventional debt-based securities because it's debt-free. As we said, it doesn't relate to interest rates. It produces steady and passive income. And it's aligned, importantly, not only with the goals of the customers, these graduated, skilled individuals, because the third leg, as we said, of our marketplace is there to help them in career guidance, if needed. If there happens to be a period of unemployment, we step in and we pause our payments. So that operates very different from the conventional loan, that if the borrower ends up in hardship, then the loan continues to pile on. Well, we don't. We pause our payments, and in addition, we provide access to certain resources through our partnership arrangements to help that borrower get back on her feet and in fact improve her earnings. An attractive rate of return is there. Typically, that's double-digit returns. And overall, we encourage you in the audience, or people that you can refer to us as investors in this new asset class, this human capital, that this can unleash the potential that is there in the educated American workforce. So in closing, let's talk about the lessons that we have learned. Even though, as I mentioned, we've been privileged to be part of a number of startups, this one of Defynance is challenging, like many startups, because it has the two sides: raising capital for the management company that does the credit underwriting, does the marketing and sales, and also manages the fund, and then attracting investors into the credit fund, which is, again, the main topic of today's speech. So what are the lessons that we've learned we'd like to share with the audience here in One Startup World? Well, central to the success of any business is the choice of business model, isn't it? And the research shows this far more important than even the amount of capital that's been raised, is to get some harmony and balance between the business models selected and the needs of the customers you're trying to serve. So Defynance is starting with a B2C model. However, we're already developing channels of communication on a B2B basis, where our entire program can be offered to corporations in which they have employees which are struggling with student loans. In fact, it might interest you to know that 8% of those Americans still servicing student loans are age 50 and above. So this is a long-standing problem that's crying out for a solution. Second, it's important to focus very clearly on what is your product and seek to be new, disruptive if possible, and better. And I always, in the businesses I'm associated with, I strive to evolve the business to become the gold standard in its vertical, in the niche that it has chosen. Third, try storytelling. I know that sounds simplistic, but frankly, it's very, very effective. So in your branding, in your advertising, in your pitch book, and so on, telling method. You can check some YouTube programs that we've developed about the hero's journey as an example of the storytelling that we've done here at Defynance. And this is effective to shareholders, to investors, and of course also to customers. But keep it simple, the storytelling. Fourth, develop rapidly your MVP. Do it fast, but be flexible in order to do what? To test. Because what you've come up with initially, it might need to be modified to be understood better, to be more effective, to be more affordable, let's say. So I usually coach that failure can be the best teacher. Don't take failure within the startup world as a stigma or as a stain on your reputation. The most successful entrepreneurs are those who fail quickly, okay? Get themselves standing up again, dust themselves off, and go back into the business arena. Number 5, I would strongly recommend that you innovate, don't imitate. Imitation is an incremental change, and there's a lot of it across globally. But the most successful businesses, you can think of a Google, for example, that came out with a search engine. This was a complete innovation. And be original. Come from your own passion. And you know, the main benefit from being original is that, and authentic, is your customers will find you. It solves a major problem often of marketing and sales. And the last 6th point is, what do investors want these days? Well, they want the triad of high yield, safety, and of course, liquidity. A lot of people have follow the traditional way of wealth building, which is in real estate. And yes, that can generate wealth. However, it is highly illiquid in most markets and doesn't always give high yield. It depends upon economic circumstances. So investors seeking value for money and a business that is scalable, we hope they will consider Defynance as one example. And these are 6 key lessons learned in our journey, which we'd like to share with you here at One Startup World. So we are currently raising a seed round to test our product market fit. And with that, I conclude my remarks. And again, thank the organizer for the opportunity. Back to you, James.
Well, thank you. Thank you very much, Omar. This is extremely interesting. And I'm saying to myself that if you're mentioning this to a student, how would you explain to the student that the money that they owe somehow turns into an asset? So how do you explain that to them to make it clear?
Farouk, would you like to handle this?
Yeah, I mean, I think from a student's perspective, our focus is more about dealing with their problem, right? Because they are buried under average of $40,000 in debt. So when we are speaking to, and when we say student, of course, we're meaning ex-students, people that are already left school, that are working, that have a job. So for them, what's top of mind is, how do I get out of debt? So number one, we pay off their student loan so that debt is removed from their credit, and that psychological burden that they're dealing with is also removed. Number two, the payments are tied to income, so they are always assured that the payment will be affordable, even in the event that their income goes down or they become unemployed. In that event, of course, we pause their payments. They don't have to make a payment, which then brings us to the third most important thing, is this ecosystem of career and financial support that we're also building as part of our marketplace. So the ex-student knows that no matter what happens, Defynance is in it with them because we have invested in them. We're not lending money to them. So we want to make sure that they're successful. And if they do encounter any hardships in life and employment, we want to minimize those. Dr. Fisher, feel free to add.
Well, I just want to add, James, I'm working on an ebook or an article that talks more precisely to your point, which is treating the earning power of the individual as human capital. And as human capital, it can be then translated into an investable asset. The asset part is the earning power of the individual. So this needs to be developed. It needs some education around it, but it's really, really exciting. And why is that? It's because it empowers the individual now to think about her or his future earnings as something that they own and that they can build upon as a form of wealth building rather than simply renting time to an employer.
Right. But even as they start earning money, they will not have to pay you back, right?
As long as they're earning more than our minimum income threshold, they will be making payments to fulfill their income sharing obligation, which is a factor of time. So anywhere from 5 to 15 years is the typical income sharing time. As long as they fulfill that obligation, then they're, then they can move on with their life and keep all their income in the future.
So in other words, making it easier for them to pay off what they owe. In a much
Right, literally, what they owed is paid off in the beginning. The debt is gone. Now they're just sharing income, which is contingent on income being above that minimum threshold. And if it's not for some reason, then the payments are paused.
Right.
Yeah.
That's
So
amazing.
actually, James, it's a different structure. So if we pay off $50,000 of student debt, it's gone.
Right.
Now the customer to Defynance and this system is debt free. And part of the reason that we have these services about career wellness, career counseling, and financial education is because a lot of our young people have grown up with a debt, I'll call it a debtor mentality. Okay, being a borrower for your car, borrower for your home. So part of our social objective is to help the next generation of leaders. Instead of thinking like debtors, I use the word earners. Become an earner. Take more control of your financial freedom.
Right.
That 50,000 still needs to be recovered.
Yeah.
By our investors. And that happens, as Farouk pointed out, through the income sharing mechanism. Okay. And it's a fixed amount of that income, which is shared over a fixed period of time.
Fixed percentage to be precise. Fixed percentage to be precise.
Yeah, fixed percentage of the earnings, and the earnings are a variable. So therefore, the amount of money that comes back to our ISA credit fund, to our investors, is a variable return. But generally, because wages have been increasing, and in the professions that we're targeting, as we said in the talk, it generally has an upward slope, right?
Yeah,
So the fixed percentage, whatever that is, 3, 4, 5, 6, 7%, it's all determined in the credit underwriting and negotiated. When was the last time you negotiated the terms of your student loan with Citibank or with Wells Fargo? It never happens.
never.
But our customers at the outset, we want them to understand that we are investing in them, in their human earning potential, in their human capital as a new asset class, as we've said, and that our goals are aligned. We want them to succeed. And therefore, the terms and conditions can be negotiated between the two parties.
Right. I mean,
And-
you don't charge them interest, do you?
No, absolutely not. There is no interest in here at all. It's just like we mentioned, income sharing. In fact, Dr. Fisher said that we invest in them, but we also have a cash reward mechanism where they can invest in themselves and get a cash reward at the end of the income sharing agreement, which is again a feature that, from our knowledge, is unique not only to income share agreements, but for any type of financing.
Yeah.
And this is, sorry, just to be clear, this is a embedded saving discipline part of our structure, James, and the audience. And so it helps with this shift from being a debtor to being an earner, and as was said, invest in yourself. So as the saving portion in the monthly recovery payments, right, which is the percentage, a fixed percentage of the income, the saving portion as it grows upon completion of the ISA agreement with our customer, then those savings are given back to the customer, which reduces the overall cost of the entire refinancing transaction. I hope that's clear.
Yeah.
And from an investor's perspective, James, it's also risk mitigation because the biggest shareholder of every income share agreement is the customer themselves. Though investors' risk is diversified in all the income share agreements that are in our fund or pool, but investors know that this biggest stakeholder is the customer themselves. So they're incentivized to do as good as they can in their career to get back as much cash as possible in this savings and reward mechanism.
This seems like an amazing idea, and it may work better than the other idea, which is the president just agrees to take away all the debt and pay it off.
Well, we know that's not happening. The Supreme Court has ruled on that. So now we
I
have,
know.
and payments are resuming in a couple of months.
I
So now
know.
people will realize that they have to find better mechanisms of dealing with their debt. And we have something, we believe, quite amazing to offer them.
Yeah, this is amazing. And well, I'd like to ask other questions, but we are close to our time. I'm afraid we can't continue much here. But this is a truly original idea, and I wish you much success with this. This is quite amazing.
Thank you, James, and the One Startup World team for giving us the opportunity.
All right. Thank you very much.
Peace and blessings. All the best.